When talking about traditional investing, we generally refer to buying an asset. You buy in at a price that you have deemed to be fair value, or, in a better situation, below fair value. You then use your patience to hold the asset as the price will hopefully appreciate. And when you judge the price of the asset to be dangerously overvalued, you make the decision to sell your position. But selling does come with a different meaning in investing, and more commonly associated in trading. This is also known as shorting. When you short sell a stock, you go against the wisdom of buy low and sell high, and simply flip the order. Your mission is to sell high and buy low. At first, this is a relatively confusing concept, but once explained, it can be another tool for you to have. And if short selling isn't for you, it's important to understand that this concept is being implemented with billions and billions of dollars per day, and it can influence the market behaviour. If you do get something valuable out of this video, please like to improve the YouTube algorithm, comment below if you have any questions or feel I've missed something, and subscribe if you've not done so already. To go short means that you sell shares which you have borrowed from a broker. After you close your short position, you must return the borrowed shares back. Not the value of the shares, but the shares themselves. The best way to explain this is through a hypothetical example. Let's say you think Tesla is overvalued. You believe the price is going to fall. Rather than waiting to buy in at a lower price to make an investment in the future, you have the option to go short immediately. So the first step is to borrow 10 shares of Tesla from your broker, valued at $400 each. The second step is that you open a short position of $4,000 by selling these shares back onto the stock market. Over a period of time, the value of Tesla shares drops below $400 to $300 per share, representing a 25% decline. At this point, you no longer believe Tesla to be overvalued, so now you want to close your short position. Because you borrowed shares from your broker, they want those shares back. The third step is you have to buy back those 10 shares valued at $300 each, costing you $3,000. Therefore, you initially made $4,000 by selling the shares. It cost you $3,000 to buy them back and return them to your broker. Your short position made you $1,000 before fees, taxes, and so on. Hopefully the example makes things a little bit clearer. So how is this different to going long? The first major difference between going long to buy shares and going short to sell shares is the way your investment is directly dependent on price swings. When going short, you hope that the price will go down, so you can return your shares to your broker at a lower price and keeping the difference in value. When going long and buying the shares, you want the price to increase and close your position when the value of your shares is higher. Another difference would be that when shorting, you aren't selling your own shares. You are selling the shares that belong to your broker that must be returned either by closing your short sale, or if the broker demands them back at any point. Whereas when buying the shares, once you pay for them, they are legally yours until you decide to close your position. So what are the benefits of short selling? One reason why shorting is so appealing to many investors and traders is due to the fact that you can increase your returns as the price is falling, something that seems too good to be true, making profits in both upswings and downswings. Another reason is to hedge your portfolio. Seen in the financial crisis, for example, it may be a good idea to have some short positions to reduce the overall downswing of your portfolio. Therefore, not all of your positions will experience a loss in bear markets. When shorting, the maximum gain would theoretically be 100%. If an asset falls from any price to zero, the gain is 100%. However, an asset can in theory rise to any price. This means you could lose more than 100% of your investment. As an example, if you shorted Apple at $100 because you thought the company was headed for a long-term decline, and the stock has now gained to $250, you would have lost 150% of your investment. Provided, of course, that the broker didn't cancel your position earlier. Borrowing a stock to short is risky because at any moment the broker who you borrowed off can recall their stocks, where the short seller has limited control on the price coverings of the position. This can seriously impact your return if stocks are recalled too early. Next, borrowing these shares will come at a cost. The broker will not let you borrow stocks for free and will charge an agreed rate that the buyer is aware of until the stocks are returned. Depending on how much the agreed rate is, this will decrease your net return of short selling your stock. The amount charged can depend on a number of factors. One thing to point out is that illiquid stocks are likely to be more expensive to borrow to short sell due to the nature of ownership and difficulty to buy and sell. To conclude, short selling is certainly not the method most associated with investing. After all, you're betting on a price crash, not a price gain, like most would usually assume. But it does have its unique advantage of allowing you to profit when things don't go on the up, giving you the advantage of profiting in both bull and bear markets. As for the risks, it is up to you to decide whether or not to short a stock. Have you done your research? And are you with a reliable and trusting broker? Have you taken into account the fees? These are all important questions you must ask yourself before committing to a short sale. We hope this video has cleared up what short selling is and the characteristics of it. If you like the video, please like to help with the YouTube algorithm, comment if we've missed anything, and subscribe if you haven't already done so. Thanks for watching.